Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So I want to share with you guys 5 different companies today that are all undervalued or either fairly valued or very close according to Seeking Alpha Quant or the Wall Street Analyst. I'm going to share with the details of these companies, just the basics, and of course if you're interested, as always, make sure you do your own research to learn more about the companies before you invest in any of the companies that we're going to talk about, because this is just for entertainment purpose only. What you see right now is in front of you is my portfolio. Right now, as you can see, it's £95,000, 128. It's come down just since the beginning of the week. I think it has just gone up a little bit. Yesterday, day before, I think it hit almost to 56,000 and it has come down a little bit. Again, of course, as usual, it goes up, it goes down. I don't really care. I just add as much money as I possibly can every single month. And I still have, I think, about £4,000 to add before April the 4th, April the 6th, inshallah. And I will continue doing that and I will share that with you guys, inshallah, moving forward. If you haven't liked the video already, please do so, because that is one of the reasons that I'm still here, one of the reasons that this channel is still going. So that will really help the channel, as well as, of course, that you can also join us in the Patreon account, where you can support the channel as, you know, as cheap as £2 basically a month. And then you'll get all the buys and sells, you get the dividend portfolios, you got the private Discord, you got Sharia compliant investing ebook, and so on. As well as that, you, of course, you get the dividend trackers, the ETF trackers, all of those things, inshallah. So it will be really helpful if you can join us here. And if you can't do that, just like the video. That's simple as that, inshallah. Right, so there are 5 companies that I want to share with you guys today, and we're just going to look at the same information as we normally do. You've seen this what is it? This thing here, where we're looking for the market cap, the moat, the price, dividend side of things. We're looking for the profit margin, return on equity, return on invested capital, just to give us an idea of how profitable the company is in terms of management, how they're actually doing with what they're doing with our money, and so on, to see if they have any free cash flow, where the company has been in the last 10 years, and then what we expect from earnings side of things, and then tell us whether they buy or sell. Of course, once you've got that information, then you can do a little bit more research. So let's get started with the first company. And the first company we're looking at today is Merck. Merck has a market cap of $323 billion. It has a wide economic moat, $125 per share right now. Dividend yield of 2.59, which is quite nice for this company. It's actually used to be about 3%. It has gone up quite a bit recently. Payout ratio 100. Payout ratio 192%. So that's going to change moving forward, and I'll show you in a second. Okay, but latest increase was 5.5%, 5-year growth rate of 9%, dividend streak of 12 years. So they have increased that dividend for the last 12 years. The annual payout right now is $3.08. Safety 99%, which is absolutely wonderful. Profit margin right now is not there. Return on equity and return on invested capital are just decent. Free cash flow right now about $13 billion, and then total return the last 10 years 11%. Growth estimate for next year is almost 14%, and then after that they say in every single year, and I had to double check this, okay, 67% for the next 5 years, which is crazy. I don't know where that's coming from. I'm gonna have to do a little bit more digging. So yeah, 4.4% right now, upside from where we are now. $132 per share, where they think the price should be. If I quickly show you the company in terms of, as you can see, buys, so we have strong buys for 16, 5 buys, and then 6 hold and 1 sell. That's from Wall Street. And then Seeking Alpha Analyst is actually 6 buys here, 1 strong buy and 3 hold, and that is just basically 2 buys there, as you can see. And that's the reason why I've included it in here. And as you can see, the revenue they're expecting to grow from $60 billion to $63 billion, then $67 billion for the next couple of years. Of course, 2023 it was a bit of a decline, but 2024 EPS is expected to be $8.51, then $9.70. And if we look at the earnings, okay, moving forward, I think this is where it's coming from, that basically massive the 2024 they're expecting. So there must be something about the company actually acquiring another business, because that's not normal. And then of course after that, you know, high double digits and then high single digits, which is quite absolutely fine. And then from there on was 6%, 5% every single year. So nothing huge to worry about in terms of this business. The next one is Sanofi. This is a pharma company based in France, and it has $118 billion market cap, wide economic moat, $46 per share right now, 4.42% in terms of dividend yield, which is quite high. Payout ratio only 44%. Latest increase. Oh, in fact, let me show you Merck's. Yeah, just wanted to share with you guys about this. Okay, earnings payout ratios for Merck right now is 192. We've seen that, but the next 12 months is going to come back to 36%. So that's why I said there's nothing huge to worry about for that company. But yeah, this one is 44%. Latest increase was 6%. 5-year growth rate of 4%. 24 years of increase in that dividend. $1.90 is what you will get for every share of this company that you own. Safety 90%, which is quite nice. 12.5% in terms of profit margin. 7% return on equity. 11% return on invested capital. Almost $9 billion of free cash flow right now. That's in US dollars. Total return in the last 10 years about 3%. Growth estimate next year about 20%, which is quite huge. And then 7% after that. Right now they're saying it's actually a buy, but it's about 4% higher than where it should be, the buy rating basically. So it's kind of fairly valued basically. That's what it is. The next one is Abbvie, another pharmaceutical company, $309 billion market cap, wide economic moat, $173 per share right now. Dividend yield of 3.5%, payout ratio only 53%. Latest increase was almost 5%. 5-year growth of 9%, 52. So this company is in the S&P 500. It has increased its dividend 50 plus years, which makes it a dividend king. Payout ratio right now, annual payout is $6.20. Safety 70%, profit margin 9%, return on equity excellent 46%, return on invested capital 24%, $24.7 billion of free cash flow right now, which is quite huge. Return on total return in the last 10 years 16%. Growth estimate next year about 9%, 3% after that. Right now it's flat. $177 per share is where they think the price should be. Right now it's 173. The next company we're looking at is Parker Hannifin Corporation. This company has $66 billion market cap, narrow economic moat. Price right now $516 per share. Dividend yield of 1.16. Payout ratio 24%. Latest increase was 11%. 5-year growth rate 15%. 67 years of increase in that dividend. Again, another dividend king. Annual payout, you get almost $6 for every share of this company that you own. Safety 94%, 13% profit margin, return on equity 25%, return on invested capital of 16%, which is really good. Free cash flow right now we're looking at 2.8%. Total return, $1 billion. Total return in the last 10 years 17%. Growth estimate next year 8%. Then 11% after that, which is really huge. 4% upside from where we are right now. $535 per share is where they think the price should be. And finally, Danone Corporation is the next one. $182 billion market cap, narrow economic moat, $244 per share right now. 0.34 and 39% in terms of dividend yield. Nothing huge to worry about, to really go crazy about. Profit payout ratio right now is 12%. Latest increase, I was reading this, but I was looking at this minus 11%, which is horrible. So latest increase are non-existent. So that's why basically there's no dividend streak. The 5-year growth rate was 10%. The annual payout right now is less than $1 basically. Safety 73%, profit margin 17%. So I wouldn't buy this company for the dividend, I'll be honest with you. And then free cash flow, return on equity 9%, return on invested capital not great. Free cash flow right now 6.7. Total return in the last 10 years 15%, which is quite nice, but then expected to grow about 14%. Then after that 3%, 6% upside from where we are now. $260 per share is where the price should be. I'm sure there are better companies out there than this one, because you're not buying it for the dividend, you're not buying the growth, maybe for that 1 year, and then after that that's just a decline. But yeah, there are other companies better than this company maybe out there. Finally, I'm going to show you in terms of Sharia compliance side of things. If you haven't liked the video yet, please do so, because it really helps the channel. And of course, don't forget to join us in the Patreon account, where you can actually support the channel, inshallah, moving forward. And there you have it. That's the 5 companies. Just post the video to have a look at. Nothing to worry about for all of them. Abbvie is actually now, I used to worry about a little bit Abbvie, but then now is actually okay in terms of interest-bearing debt, interest-bearing securities and all of that. And then Parker Hannifin Corporation also 24% when it comes to interest-bearing debt. Other than that, they are also, all of them are absolutely fine. Nothing to worry about. I've got another video coming up, InshaAllah, to go over 5 companies that are also in a similar kind of position. So they are undervalued according to the according to Seeking Alpha system, as well as of course the analyst, that are high growth companies. So these are dividend paying companies. The next ones will be high just to be on the basically, where is Merck? Here we go. So that's the company I wanted to show you. So because this is the only one that I own in my portfolio that I have talked about today, just to be transparent. Okay, my price was $77 per share. Let's call it $78 per share. Right now 120. I'm up about 74%, 75% since I start buying this company. So inshallah, I'm going to do a little bit more digging in this company for the next few weeks, and the reason is because I want to see if the growth, what they're saying, where that growth is coming from, that they've actually said. And also the margins are not great. So I want to see what the company is expecting in the moving forward. And if basically things are true and things are not looking good, or whatever the case might be, then I can take this completely off the table, the profit of over £1,000, and then buy a company maybe like Abbvie, which has a better dividend. And of course, Abbvie has just lost their patent. So again, it's going to need for a few more years to bounce back. But again, I'm going to do a bit more research. I'm not saying I'm going to sell it, but I'll let you know, inshallah, what I've done. As always, I'll share exactly what I'm doing with every single stock that I have in this portfolio, inshallah. Have a wonderful day. Assalamu Alaikum.